Okay, testing, 1, 2, 3. Okay, testing, 1, 2, 3. Okay, testing,
Well, that
1,
sounds
2,
good.
3. Okay, testing.
I got a loop going.
Hey, that sounded pretty good. All right, hey, sorry for that. For some reason, I lost everything for the stream. Like, I had no files. What? So, sorry about that. Yeah, it was weird. It's just, yeah. So anyways, yeah, so all my files are gone. Hang on now, hang on. We're almost there, Bubba. We got through it together. And I need a disclaimer. It was just here as well. Holy smokes. Hang on, it's here. Man, it's crazy. Everything is gone. Anyways, well, I'm supposed to show a logo, so to the good people at the NFA, hey, I'm trying, man. I'm trying. I don't know what went wrong. But anyways, let me remind you that trading is risky. It's not appropriate for everyone. Your past performance, good or bad, it's not necessarily indicative of future results. But please stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. So I don't have any scenes here, but hang on. Why can't I see this? We're going to view. How come I can't do view? View over here. View. Extra large, small, large icons. Hang on. I got the disclaimer here. They really want you to show the disclaimer. During one of my audits with them, they sat down, they had an officer sit here for days and days watching hundreds of my YouTube videos. Oh, here it is. Ensuring that every single one of them had a disclaimer. And they found one without, and they were pissed off. I had to yell at Kurt Worley, and it really bothered me. They forced me. Anyways, here we go. Let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. Cool, so I'm glad we got all that set. Let me get a coffee, sorry. All right, what a morning. Hey, I really apologize for that, but this is like, what, the 184th non-farm payrolls? And for some reason, today, the files weren't there. My streaming files. We're not there. I'm like, oh my God. So, yeah, that's weird. But anyways, welcome to the world. So I think this will do, eh? I think this will do. Let me close this window. I got the chat over there. I see over here. Very cool. So anyways, good morning. Good morning. My name is Wayne McDonell. I'm a currency trader just like you, Bubba. Yeah, that's kind of a weird aspect ratio, huh? Anyways, hey, my name is Wayne. Nice to meet you. So here's my story. I love trading Forex. Forex is the best thing on the planet to be trading. You can have things like wonderful levels of leverage. What else? Taxation is quite favorable, even in the United States of America. Liquidity. Think about that. Your trading and investing is just straight up liquid. You are liquid all the time. Isn't that amazing? You're liquid all the time. If you buy real estate, you're hoping the value will go up. And if it's commercial real estate like a multifamily apartment building, there's income attached to that. That's really cool. And it'll go up in value when things are good because your rents are going up. That's cool. And you're leveraged. You have a mortgage. Cool. Tied to the market value of the property. But then all of a sudden, the economy collapses. People stop paying rent because they've lost their job. Now rents are coming down. Revenue is coming down. The value of your property is coming down right at a time when you're trying to refinance your property. You have a $2 million mortgage, but the property value dropped. And now the bank says, well, you're asking for another $2 million loan. But the way we look at it, your property is only worth $1.8 million. Now what do you do? Ha, ha, ha. Oh, you're in trouble. Forex, liquid. You want out? Out. You want in? In. Okay? More than $6 trillion a day. So that is an incredible opportunity. So I love Forex. And as you can tell, I've been doing this a while. This is trade non-farm payrolls, what? 184, I think it is. 184 months. I've been doing this one webinar at FX Street. How many years is that? It's like 15, isn't it? Pretty amazing. So anyways, we will have 3 hours here today. Thank you to FX Street for hosting me once again. Okay, so I have up to 3 hours. And we could discuss technical and fundamental analysis as well as trade non-farm payrolls, the volume and volatility that we get from it. Okay. I'm the Chief FX Market Strategist for TradersWay.com, a boutique foreign exchange broker. And I'm here to earn your loyalty and respect. And I will do that through education. Okay? Through education. Okay? Now, what am I going to teach you? How about trader psychology, technical analysis, and fundamental analysis? I've passed this series 3 from the Commodities Futures Trading Commission and the National Futures Association and FINRA. Cool. I have a macroeconomics degree from Harvard. I have a master's degree from Harvard in financial management. Cool. Studied alternative investing at Harvard Business School, post-grad. Studied cryptocurrencies at MIT with Gary Gensler, who is the former head of the CFTC, which runs the National Futures Association, which regulates Forex. So think of it. Forex's boss was Gary Gensler. Then he went to MIT and taught me cryptocurrencies. Literally, he was my professor. And now, about a month ago, as soon as my program was over, he was hired to run the Securities and Exchange Commission. And now he wants to regulate cryptocurrencies. So he taught me cryptocurrencies. How cool is that? Thumbs up. Good job, Gary. Now what? And I just finished an algorithmic trading program at Oxford University. So I can share a lot about all of this if you ask good questions. I am happy to share. And hopefully all of this experience will just lead to maybe, perhaps, a better structure in the process of making decisions. Ultimately, what I want to teach you is how to plan. Okay? Any idiot could pop into a trade. Okay? However, what I'd like for you to do is work on your strategy formed by gathering intelligence. Okay? You have to gather intelligence and then formulate a strategy. Okay? And then jump in, then trade. Okay? FT9 says, has anyone in the community knows how to install the currency indices individually? Yeah. You install the file, bro. FT9, maybe you downloaded the file from metatraders.com, a year ago. Those files have been updated and the code has actually been rewritten. So maybe run the installer again and maybe the new file will work better for you. Okay. I forgot to tell people, but every single template, file, EA, indicator had been rewritten and updated. Cool. I just forgot to tell everybody. All right. Cool. So anyways, hey, tradersway.com. Please visit Traders Way. Simple enough. Open up a demo account. Give Traders Way an opportunity to earn your loyalty and respect, because ultimately the most important thing that you need when choosing a broker isn't spread, okay? But Traders Way spread is competitive. It's not execution speed, although Traders Way's execution speed is much faster than most, tested by an independent third party. Customer service is important, yeah. Swaps. Hey, your current broker probably gives you negative swap whether you're long or short. Traders Way doesn't play games like that. They actually pay you huge swaps. Huge swaps. Like you're trading billions. You're getting these huge swaps, so that's good. So anyways, trust. Tradersway.com. Anyways, let's look at this. I was monkeying around with this stuff, changed some of the time periods. Let's just make sure I got congruency here. Okay, daily, weekly, daily, weekly, daily, weekly, daily, weekly, daily, 4 hour, daily. All right. Here's what we're looking at. This is the dollar versus everything. And you're like, oh, Wayne, you mean like the dollar index? Well, sort of. Okay. The dollar index is a non-equally weighted basket. So There might be a lot of euro, not much CAD. So is it fair? It's a basket. What can I tell you? It's a basket. These indices are simply the dollar versus everything in the G8. And this is Swiss franc versus Aussie, Swiss franc versus euro, Swiss franc versus CAD, Swiss franc versus yens, Swiss franc versus dollar, Swiss franc versus Kiwi, Swiss franc versus pound, and so on. So we'll call it G10. Cool. So Swiss franc versus everything since the middle of July has been quite strong, although in the first few days of August, it's weakened it a little bit. Kiwi has gained a lot of strength recently. Pound has gained a lot of strength recently. A little bit hawkish tone out of the Bank of England, as you probably know. Up, down, turn around Aussie. Euro getting beat like a dirty dog. CAD recovering. And yen stabilizing. Cool. Okay. Demo trader says, hey, what is a swap? It's the interest you earn on a carry trade. So think of it like this. You buy a bond and it pays you interest. Okay. Well, in currencies, you earn interest because you might be leveraging with US dollar to buy New Zealand dollar, and New Zealand will pay you an interest. You're investing into New Zealand and they will pay you interest for that loan. You're loaning New Zealand money. You're loaning New Zealand US dollars. Now, the cool thing is I can use my USD. Okay, so I have US dollars in my account. I can use my USD as leverage, or I can leverage it up. I can use it as collateral and say, hey, Trader's Way, I want to take some of my US dollars in the form of cash, and I'd like to buy some Japanese yen with it at 100 to 1 leverage, or 50 to 1 if you're in the United States. So all you're doing is using the US dollar as collateral. So for every $1, you can buy $100 of Japanese yen. And then I now own all this Japanese yen. But what I want to do is loan it to Australia. And Australia will pay me interest. Now, I borrowed Japanese yen from Japan. I'll have to pay them. What I'm trying to do is say, the loan interest payment ideally is less, right? Ideally, well, hopefully, right? The loan interest rate is less than the income interest rate I'm earning by loaning the yen to Japan. And we call that a carry trade. Now, the way to check for this, okay? Let's test your broker versus Trader's Way. You can go to like USD Mexican peso and you can click this thing called specification. Okay. And here's the cool thing about MetaTrader. There are many things. They show you if you're short, how much interest you're going to earn. And it's not quite right, but you can kind of think of this as, annual income if you want. Annual interest rate. All right. And then how much you earn if you're long, how much you earn if you're short. So you can see that the interest rate in the United States is significantly lower than the interest rate in Mexico. Okay. Now there's some other costs involved, obviously, but I bet you, I don't bet, but if you open up your current broker, okay, if you open up your current broker and do this, I would not be shocked if you lost money either way. Instead of you earning money on the short side, Okay? You lose money either way. Okay? Mexican interest rate. Okay? So the United States has an interest rate of 0 or nearly 0. And right now, it's 4.25% in the United States. So what you could do now is borrow money from the United States for nearly free and lend that money to Mexico. And they'll pay you 4.25. Does your bank pay you 4.25? No. If you lend the U.S. government money, they will pay you 1.25. Okay, that's a 10-year T-note, by the way. This is the least. You can do now, how about Mexican peso 10-year bond yield. Let's compare apples to apples. If you lend the United States money, they on a 10-year T-note today, you will be paid 1.25% per year. That's the going rate, which is pretty good because that's significantly better than 2 days ago. But if you lent the money from the United States, or lent the money to Mexico, they'll pay you 7.15. So let's just say if you borrowed money at 1.25 and you lent it, then you, right? So borrowing, you leverage this up times 100. Okay? So now you're leveraged 100 to 1. But then you go here and lend it to Mexico. What does this, what's the equivalent now? Well, let's just say the difference between this and this, let's just say it's 6%. That's pretty good, right? You borrow money here and you lend it to Mexico. We call this swap or carry. Now, the interesting thing about being a currency trader is that you can take advantage of this leverage. I'm not suggesting this is right. You might want less leverage. But the reason you do it now is you're earning 6% on the money you lent to Mexico, but you only have 1% of your cash in this deal. The other 99% is borrowed cash through leverage, but you're getting paid on 100%. So you're earning 6% on the loan you gave, but you're earning 600% on your cash. And the way that you describe this financially, okay, right? Just so you know, this might be interesting because you might have heard this before. This is your internal rate of return. A venture capitalist will play this game. They'll say, oh, I have a 600% return on the money deployed, but then they may have not deployed a lot of money or something. Okay. So anyways, on your cash investment out of your account, remember you're leveraged 100 to 1, you're borrowing, so you have a cost, but you're also got an income. And the difference here is 6% times your level of leverage. So 600% per year, for example. Now, what's the equivalent? Like, what does this add up to? I think it adds up to per mini lot, okay, per mini, you're earning 50 cents a day. Okay. Remember, you're not borrowing 10-year T-notes, you're borrowing cash. And there's also costs and stuff like that involved in the whole process. And you're like, so 50 cents a day per mini lot $5 a day per standard lot. What's the big deal, right? What's the big deal? Well, think of it if you had a lot of money. Okay? So, right? So let's do this. Clear this up. Let's say per standard lot then. $5 a day times $365 a day. Okay? Okay? In interest collected, you would collect per standard lot 1,825% per year. Is that good? Well, you only have approximately $1,000 of your cash invested. So, just in interest collected, okay, 182.5% return on ROI. That's a pretty good year. Plus pips. Oh my gourd. Oh my gourd. Oh my gourd. Holy smokes. Becky, look at the size of those pips. So interest collected plus pips. Now, if you were $1 billion Forex fund, how would you like to collect that kind of income on your investments plus asset appreciation? Would you still be a scalper? Probably not. You'd probably say, I need to figure out peso. I need to learn everything I can about Mexico. I also need to learn everything I can about the Fed and the policies at the Fed and the policies at the Bank of Mexico. And by the way, the Bank of Mexico has a wonderful website. They have some of the best research in the world. It's fabulous. Yeah, some of it's in Spanish, but get over that. Okay? How interesting, huh? Okay? $182%. Now, likely, if you're managing $1 billion, you won't be leveraged 100 to 1. Okay? So if you're leveraged 50 to 1, which is much more similar to like a futures contract, so 50 to 1 would probably be all right. Okay? So you're only going to earn what? 90% a year in interest. Plus pips. And of course, if you're a proper currency trader, right, the pips are way bigger than that. Okay? Oh my gosh, right, demo trader? All of a sudden you're like, well, this is probably how the big boys are investing. Well, that's one way. There's risks associated with emerging markets. So there was a time when New Zealand paid you 8.25%. Less risky, let's say, than Mexico, less risky than South Africa. Okay? If you want to learn more about carry trading, I would suggest you research John Taylor and a company called FX Concepts. He was the first Forex hedge fund. And he used to pay himself $25 million a year. It might have been $25 million a month, though. Honestly, I can't remember. But he paid himself a lot of money. Him personally, not his profits in the company, all that kind of stuff. That was his salary. And he did it for decades. The interesting point here, not only was he the first hedge fund, not only did he manage billions of dollars, many, many, many billions of dollars for decades, for institutions, right? But the interesting thing is he was a true hedge fund. They didn't make any pips. All they did was the carry. All they did was earn income on swap. Okay? Kanana says, hey, or Turkey. Turkey's not really a tradable asset anymore, but yeah, Turkey was a good one. So just to put that in concept, I had an internal rate of return on a Turkish lira trade I did as an example, I don't know, 3 years ago. And I held it for almost 1 year. I think I held it for 10 months. Sorry, I'm so used to doing 10 years. 10 months. It was an example trade. I held it for 10 months. Okay. And when it closed, I made 0 pips, but an internal rate of return of 1,000%. I turned $100 into $1,000 trading, I forget what it was, USD lira, I think. Can anybody confirm this? Is this true? 1,000% internal rate of return on a trade. I held it for 10 months and I made 0 pips. It's kind of cool, right? Yeah. It's wild, huh? So anyway, it's just food for thought. I'm not saying it's right and what you're doing is wrong. I'm not saying that. Just food for thought. All right, let's talk non-farm payrolls. We got 15 minutes. All right. We can go through a lot of data. You already know ADP was disappointing. You already know ISM services was surprisingly good. You're probably watching weekly jobless claims. You should already know this stuff. Now, did you do Challenger Christmas in gray like I showed you last month? Probably not, but whatever. Here's the thing. Some of the experts, quote unquote, said 385,000. What's expected is 885,000. And some people think 1.25 million. Okay? It doesn't matter to me. So we'll get there. What matters? In June, the market thought the Fed was going to taper. Now, I said, or announced the taper, and I said that was stupid. But whatever. This is what the market thought. This is how the market behaved. They said it was going to be announced in June. It's going to be announced in June. It's going to be announced in June. They have to do something. Inflation is high. COVID. All this speculation and garbage and nonsense. Okay, what? Great. So let's look at Fred. Okay, let's go to the Federal Reserve Bank and do some economic research. Okay, what do we want to do? We can do 10-year yield. I didn't get that one right? Did I misspell it? I-E. 10-year break even. I could do that. In Treasury effective Fed funds rate. I'll bring that up just for fun. Okay? Look. Nothing's happening here on the Fed funds rate. I can zoom in a little bit. Okay? This is COVID, interest rates coming down, and interest rates are generally 0. This is the Fed funds rate. 10-year Treasury. Let's see if I can find it. 10-year constant maturity. I guess we can look at this. Is this right? Yeah. Okay, so way out here before COVID, interest rates went as high as, or on the 10-year T-note, the Treasury, went from 3, then we were at 2, and then cut all the way back down. Okay? Okay, we get a recovery. The yield on the 10-year is going up, 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 up until about May. And all of a sudden, whoa, 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 whoa. Down, 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 down. My point is here in June, okay, there's the June Fed meeting, or June non-farm payrolls. You can see the market was preparing, and then what happened? Yields fell. What does that mean? What does that mean? Well, this is an interest rate. Interest rates fell because people bought bonds. Now, what did they buy actually? Okay. Inflation protection. Okay. Going here to June. Look at this. You know what this is? This is the 10-year T-note minus inflation. There's a negative real yield is what we call it. Okay? You can see this June area was a huge turning point. People thought the Fed was going to raise interest rates to kill inflation. So they were prepared to short the bond market because they thought the peak of prices in the bond market had been achieved and that bonds would fall and interest rates would rise. Since this period, there's been a few hedge funds that have blown up because they bet interest rates were going to go up. By betting, what I mean is they were selling the bond market because they were certain the Fed would stop buying. That's what a taper is. They were certain the Fed was going to announce that the Fed was going to reduce and eventually stop buying bonds. Does that sound like bullish? A bull market indicates buyers. Well, someone buying $80 billion in treasuries every month. Remember, the other $40 billion is in mortgage-backed securities. So they were betting, right? They were betting the Fed was going to announce they're going to stop buying bonds. Therefore, the bond market would fall and interest rates would rise. 10-year T-note should probably be at 3% is what they were betting on. And guess what? We can see here how wrong they were. Okay? That's interesting, right? Now, we're set now, not for June, but I want you to think of market psychology of June. They were certain the Fed was going to announce a taper. Well, don't we have something similar now where the media is hyping up a big September Fed meeting decision where they're going to announce a taper? My thought here is people could very likely be wrong again. Like they were wrong in June. They're probably wrong in September. Now, we don't know, but I think non-farm payrolls is going to be important. So let's discuss that. Non-farm payrolls, people are expecting 885 or whatever. I don't care what your number is, okay? It could be 800, it could be 900, doesn't matter. A big non-farm payrolls. And then they'll say that will force the Fed to taper because we don't need so much stimulus. Okay, I understand that. And you could look at ADP, that's a miss. You could look at ISM services and its employment subcomponent. You could look at weekly jobless claims, so on and so forth, and try to determine whether this is true or not. All of that is great. You should have already done it. I've already taught you. I've wrote an article at FXStreet about it. Okay. Now, this year, this month, I also have anecdotal research, which is, okay, this is the United States of America. Okay. And in July, I visited this part of the United States, the southern border. Okay. If I went any farther south, I'd be wet. Yeah. I was on the Gulf of Mexico. There was no more south. Yeah, I could go south in Texas or I can go south in Florida, but for where I was standing, I couldn't go farther south. Okay. And then a week later, I was here on the northern border of the United States. Okay. And so I drove all the way from Atlanta, all through Alabama and Florida and all the little mini cities in between and the tourist traps. I went to restaurants and bars and hotels and all that kind of stuff. I also flew to Chicago, spent a couple of days in Chicago, right on the river. It was beautiful. Once again, restaurants, tourist traps, was at the airport, right? Restaurants, bars, hotels. And then drove all the way here through Illinois and Wisconsin. Once again, stopping in little towns so I could see things like fast food restaurants, gas stations, and eventually I got to the Canadian border where I was in the woods. But I still traded Forex, by the way. Here's what I'm getting at. My anecdotal evidence of visiting, Google told me it was like 28 towns or something, right? Right? Haven't stopped and talked to people. And I talk to people everywhere, at Starbucks, at the gas station, just everywhere, right? Here's what I found. Every gas station has help wanted sign. Every gas station also needs truckers. There's signs. If you want to be a trucker to deliver gas every morning, they need you. You get hired on the spot. Every restaurant needed waiters. They needed cooks. They needed kitchen staff, busboys. Okay. Every Starbucks was hiring. Every hotel needed people for the front desk. Every hotel for the bellhop. Everyone for cleaning rooms. Every hotel needed kitchen staff and cooks and waitresses. Okay. Whether you were in Florida, okay, Atlanta, Chicago, right? Northern Wisconsin. And I'll tell you what, okay? There were jobs, but not workers. Okay? There was no workers, but lots of jobs. The second thing is there were tons of tourists. Tons of tourists. There was enough. Like, there were people visiting. So when I was in Florida, for example, there were 3 and 4 hour waits for dinner because there was tons of tourists and no workers. Okay. So now going back to non-farm payrolls coming out in 3.5 minutes. People are thinking 885 because they're doing their research and they're probably looking at normal distributions and normal trends and all that kind of stuff. But my anecdotal evidence or anecdotal, let's say primary research tells me, oh my God, we're going to miss. And if we miss, I would say it's almost certain the Fed does not announce a taper in September. They're going to wait. They're going to wait for unemployment benefits to expire and see if people go back to work. They're going to wait for schools in the Northeast to reopen and send kids there as a form of health, as a form of childcare. So waitresses could start working at Applebee's again. But I think if we don't get like a big, huge number, like 1 million out of this, then I think it's going to be very debatable about the taper announced in September or starting in September. I think more likely we're going to miss on headline non-farm payrolls. That's just a guess. Okay. However, if that happens, if it comes out 385,000 like ADP suggests, then guess what? We're not even going to talk about it. We're not going to get a taper until maybe December. And by the way, back in 2013, when they announced a taper, it was the December meeting, not the September meeting. Okay? So I'll tell you what. The media is probably wrong. Okay? You understand? Well, yeah, but less so. You have to understand there's things that need to be done. So what they're going to do is wait for September and October and get that information and announce in December and maybe start in 2022. Okay? Okay? So 870, fine. Okay, fine. I can give you this link if you want. Okay. And the reason I showed you negative real interest rates is I want you to think if real interest rates have been going negative and falling more and more negative since the June meeting, I want you to ask yourself, what did the dollar do in that period? And therefore, if a taper isn't announced, what do you think will happen again? Okay. $9.43. All right, there you go. My anecdotal research does not agree with the fuzzy logic. Take a look at this. Big number, huh? That's really big. All right. Let's go back to here. Let's move this to 4 hour. I want this to be a little more sensitive. I wanted to show you the longer term trend to understand where we were. Let's go back to this 4 hour. All right. Dollar strength. So what I want to see here is bigger levels of support and resistance. Okay. So right now, what you're doing is you're measuring this top, okay, and you're looking for something like this, okay. So you have to, if you believe that's support, Okay. And if you believe this is higher high after support, this is weekly, by the way, then your next one is inside the wick. Okay. And you might be looking for that. So now you got to go much smaller. Okay. Okay. So interest rates going up. Okay. Cool. That's the thought process. So you'll see, for example, what you want to, in your evidence, pay attention to the real yield. Okay. Real yield. Okay. And the right Treasury. So it's the same thing. Treasury inflated index long-term average yield. Okay. Oh, come on, Fred. Trying to get this. Okay. So you can see the real yield is quite negative on this one, long-term, the long-term yield. They're not using 10-year, they're using something else for this one. Okay. So this one's stabilizing. Okay. Let's do Kiwi. Zoom in here a little bit. You can see the trough we're riding. This is a low. This is a higher low. Okay. And this is next week's buy zone, which I have labeled here. But basically, the plan from 2 days ago was buy a dip in here and take it north. Next stop is, I have this as about 71.70. Okay, you see that? Okay. So let's dive in even smaller. Okay, so now what you want to do is drag this across and remind yourself that that's sort of the buy zone here. You have to decide, is this 70.5 the number? Okay. Right now it's forming off here, which is kind of just gobbledygook. I wouldn't make a big stink about that. I think that's just consolidation while we waited for NFP. Okay. So there's ways that you can play this. You can measure the downward move and look for evidence that the downward move is over. So you can do it like that. You can do it like that. And what you're looking for is more of a up, down, up, down, up, down motion. Alton says the 10-year T-note spiked up instantly. Well, I'm assuming you mean yield. And what that means is they are betting that the Fed is going to announce a taper. And by tapering, they leave the bond market. And by the bond market having less market participants to the tune of 80 billion a month, that then bond prices would fall and that yield would go up. Okay. Just as I explained it before the non-farm payrolls. Okay. Now, the interesting thing is, remember, the dollar gets strong when foreigners buy it. Stop thinking good or bad. Okay? Okay? Alton says, that's what I taught us. Yes. Okay? So will foreigners buy this? Well, here's the problem. Foreigners have already bought bonds, and bond prices are likely to fall. I want you to think of it not necessarily as a higher yield, but a falling market. Now, if you own a bond at a certain price and it pays you a certain yield, you can hold it till maturity and it'll just expire. Cool. But if you're trading bonds, the market's gone from bullish to bearish fundamentally. And that's going to squeeze a lot of people out of the bond market. And they'll have to put their money somewhere else. Maybe the stock market, for example. Maybe they'll invest overseas. But on the long run, okay, right? Like you could do it like long run aggregate demand if you're an economist, right? On the long run, what we're saying is the USA needs less or no stimulus. That the worst is over and things are going to improve. Now, the stock market's at an all-time high yesterday. By the stock market, I mean the S&P 500. But that's because the Fed gave us free money. Okay? Cool. So now, with asset prices going up and real estate prices going up, and that's what quantitative easing is supposed to do, by the way, push up asset prices. The stock market went up. Okay? Stocks went up. Okay? Real estate went up. Okay? And the bond market went up. Isn't that weird? So if you own an asset, you are richer than you used to be. Thank you to the Fed. If you're poor, you're still poor and it don't matter none. Okay? But if you own stuff, if you own a stock or if you own a company, the value of those companies went up. If you own a house or an apartment building, the value of those things went up. Why? Because loans were cheap. And loans were easy to get if you had credit. So therefore, that forces prices up. If you understand real estate finance, and I did a whole class on real estate finance, if you understand that, well, the low interest rate changes the model, which pushes up the price. If you understand the formulas, it's mechanical. Boom, prices of real estate go up. And oddly enough, the bond market's going to go up. Okay, now if the Fed leaves the bond market, what happens? Well, $80 billion a month is a pretty decent amount of money, right? So maybe somewhere between sideways, I think more sideways than anything, okay? Sideways to down on the bond market. But I think the stock market will continue to go up. And I think real estate will continue to go up. Because the Fed's not buying the stock market. The Fed's not buying real estate. They're buying mortgage-backed securities, which provides liquidity. But we don't really need that liquidity anymore. There's lots of savings in the bank. And you have to remember, savings is equal to investment. And the reason it is you put money in the bank and the bank loans it out in the form of a mortgage. They don't really need the Fed to back up Fannie Mae and all that kind of stuff. There's plenty of cash in the world. So real estate's going to continue going up. The stock market's going to continue going up. People will take jobs. They'll earn income. And they'll spend, right, or save. How do we account for that? Consumption plus investment plus government spending. That's domestic GDP. That's a closed economy GDP. So right? We have lots of cash and it's going into savings, although there's low demand for loans right now. Government spending has gone way up. And we're hoping that if people have jobs and feel good about the future, they're also going to increase consumption. You see this? What does this mean? Well, in this context, it means nothing for the US dollar. So don't think about, non-farm payrolls, good, right? And you make a trade. Or non-farm payrolls, bad. And very often they say bad, sell the dollar, good, buy the dollar. That's actually quite wrong. It's amazingly wrong. Why is that? Well, the United States, is not a closed economy. It exports and it imports. Oh. So think about who's in control here. This is labor buying stuff. This is businesses buying stuff. This is government buying stuff. And this is foreigners buying stuff because it's exports minus imports. In the United States, this is a negative number. So what does that mean? When consumption is going up, investment's going up, and government spending is going up, none of this impacts the dollar, but it does, right? It may show you that some of the spending is, almost all of this is domestic, but it'll show you if the economy is likely expanding or contracting. So let's just say higher consumption, higher investment is an expansionary market where things like next year will be better than this year, for example, right? 2022 is going to be a decent year, don't you think? Well, that comes down to your opinion. Right? So if the market seems to be expansionary, what do you think imports are going to do? Up or down? Imports are likely to go up. What does this mean? Imports will be greater than exports, and that's negative. So what does that do? If we are importing stuff, so stuff from Japan comes to the United States, stuff from Germany comes to the United States. Stuff from Canada comes to the United States. Germany, BMWs. Japan, Toyotas. Canada, oil. It's not true, but whatever. It could be financial services, whatever. If this stuff is coming to the United States, oil, BMW, and Honda, let's say, the United States has Hondas, oil, and BMWs. What does the United States give up in this trade? Remember, this is a Forex trade. They bought something and they have to give up something. If I buy euro dollar, I'm buying euro and I'm giving up dollar. So this would say the United States gets a Honda, but they lose dollars. If they buy oil from Canada, they get oil, but they lose the US dollar. If you buy a BMW or a Porsche or a Mercedes, or a Volkswagen from Germany, you get a vehicle, but you give up your US dollar. So when consumption, are you listening? A lot of people get this wrong. When consumption's going up, things are good. When investment's going up, things are good. If government's increasing spending, it's because they want to increase consumption and investment. And when that happens, sure, we'll export because we make stuff, but we import a heck of a lot more. So when things are good, the dollar should weaken. Because we're buying more Hondas, we're buying more oil, we're buying more BMWs. Okay? And that's what matters most, because if you bought a Ford, okay, let's talk about this just for a brief second here. If government spending increases, okay, so you get a stimulus check. Money just shows up from the government. Government spent money. So now you go out and you consume because you got more money than you used to because of the government spending. What do you consume? A Ford. What does that do for the US dollar? Nothing. We're currency traders. So you're looking at economic data and you're like, look at the non-farm payrolls. That was great. And then what? You do something because it's good. That was a good non-farm payrolls. So you make a decision on the dollar. Do you understand? Like, good and bad are irrelevant. It's in which ways, and what's more important is what will the Fed do next? And how will that drive the flow of money outside of consumption, investment, and government spending? Okay? This domestic economy is irrelevant. So you have to take it another step further. Don't just think good or bad. This is good or bad. Okay? The Fed will likely announce a taper, it seems like, and they'll maybe start in December, like they did last time there was a taper. And they will slowly leave the bond market, and likely the bond market in terms of price will fall, and the bond market in terms of yield will go up. Okay? What will that do? Well, some people will sell the bond market. I think a lot of people will just leave the bond market, or they're going to hold till maturity because they got their money locked up. But the other interesting, weird thing is those negative real interest rates I was showing you. If you could buy suddenly a 10-year T-note, okay, let's say inflation's 2% on long run, and the 10-year T-note goes back to 2%. In real terms, you're making zero. Well, right now you're earning negative 0.5%. Okay? In 2 years from now, the 10-year T-note's probably going to be paying 3%, like it did 3 years ago. Okay? Minus 2% inflation. And you're like, but Wayne, inflation's high. Transitory, bro. Okay? All of a sudden now, in 2 years, you'll be earning 1.0 in real terms. What if you were locked up in this negative yield? Well, the problem is you would have to sell your bond that's still paying negative half. Who the heck would buy that from you? When you could buy a fresh cut bond, or treasury in this case, that pays you 3%. Minus inflation, you're still positive. Why would you buy an old treasury that charges you money to hold it? You see how all of a sudden those people will be forced to either sell for a heavy loss in the cash market, but you know they're not likely to do that. Instead, they're just going to hold it till maturity until it matures and expires. Okay? And think about the Fed that bought treasuries at 3% and 2.5% and 2%. The Fed's actually turning a profit. How cool is that? Okay, so what does this mean? I don't think the bond market's going to crash. Therefore, I don't think interest rates are going to skyrocket. But I think maybe we'll get closer to 2% on a 10-year T-note. Okay? 3 months ago, the 10-year T-note, the 10-year, okay, paid 1.5%. Then it dropped to 1.125%. And then the last time I looked, it was 1.25%. And I bet you it's gone up since non-farm payrolls. Okay, 1.3%. Okay. 5 days ago, it was paying 1.2, less than 1.2. Now we're at 1.3. Okay. From Monday to Friday, we went from less than 1.2. 1.18 to 1.3. That's a huge rally in yield in just 5 days. Okay, huge, which means the bond market's falling. So the interesting thing is, are foreigners going to buy a falling market? And if foreigners buy a falling market, okay, remember, the stock market's tiny relative to the treasury and bond market. Tiny. Okay? The only thing bigger than the bond and treasury market is Forex. The only thing more liquid than the bond and treasury market is Forex. So you can look at bond market very similar as you look at the Forex market. In fact, if you were hired by a bank, you will work in the fixed income, commodity, and currency department, which means bonds, gold, and dollar. Okay? So you'll be the dollar boy. Hey, boy, get me some dollar, right? But right? Your boss will be a bond trader. And you have to get the idea that as a currency trader, you're tracking the flow of bonds. Okay? And that's how you should face your fundamental analysis of the foreign exchange market. What is going on at the central bank? How will this impact bond investors, in particular foreign bond investors, because that will dictate the flow of money. And that's what we trade, money flow. Okay? So, pick your prices. Okay? You can trap. So like the way I have it trapped here is maybe by the end of the day or maybe on Monday morning, you will get a move like this. If you think money starts to turn away from the U.S. bond market. Now, why were people buying bonds? Well, they wanted to protect themselves from inflation. That's what TIPS are. And I showed you Treasury inflation protected TIPS. So it's built-in insurance for inflation. So it's a bond with inflation insurance. Okay, cool. So people are locking in. They're worried about interest rates going up. Also, if the Fed is buying, so go back to June. Think about it. In June, the Fed said they will continue buying 80 billion. I'm not including mortgage-backed securities. That's a different market. 80 billion in bonds in June. $80 billion in July. $80 billion in August. $80 billion in September, and so forth, so on and so forth. Okay? Think of the behavioral finance here. You know there will be a buyer. Well, if you were to price your house, you were thinking about putting your house on the market, and you know for sure buyers would show up, how would you price it? Low? You wouldn't price it low because you're like, dude, people are going to show up. If anything, I'm going to price it high and see what happens. Let them come in and give me some offers. Their offers might be higher than what I really want to sell it for. But you're going in pretty confident, right? In a weird sense, the bond market is betting the bond market in terms of price goes up. So they're buying to front run the future buying and the future buying and the future buying and the future buying. And they're like, dude, there is money flowing into this market. Prices are always going to go up in that scenario. So people are buying it in June to front run the Fed. And then they're buying it in July to front run the Fed. Okay? And you get an upward move like this. So if the market believes that that's going to change, then you've probably, okay, are going to have a peak. The peak might be today, or the peak could be when it's announced. Because if they do announce in September, I still have my doubts, but let's say they announce in September that they're going to start in December. Okay? Well, then at that point, people are like, oh my God, all that money rolling into the market is now coming out of the market. Now you're not going to be able to front run. And like you'll get a chart like this if we were looking at the price of bonds. Now, we don't look at price of bonds. We track interest rates, don't we? So in this case, you're going to get a bottom of low interest rates. Okay? And the 10-year tips now, if I go back to the St. Louis Fed, I don't have it. Let me open up. Okay. Let me open it up again. Fred. Okay, when you look at the 10-year now, 10-year tips. 10-year tip. Okay, look at this, guys. The real yield is negative 1.2. People could argue interest rates in the United States right now are negative 1.2%. So, if you believe the Fed now will taper, then interest rates will start to go up. The bond market will fall, and that money needs to go somewhere else. The stock market. Typically, when the bond market falls, the stock market goes up. Well, the Fed has been manipulating the bond market. So the bonds have been going up while the stock market's going to go up. Well, if the Fed stops manipulating the bond market will fall, and now the stock market is likely to go up. The normal correlation is what? Stocks are up, right? And bonds are down. Isn't that normal? So now if bonds actually turn negative and the Fed is out of the way, no longer manipulating, maybe we just get a resumption. Maybe there's another 3 or 4 or 5 years of stock market rally. There's 7 million people without a job, but I swear to you, there's 12 million frickin' jobs. And you can make a lot more money off of welfare if you're in a job, hopefully. Okay? So all of that means if people get jobs and earn money and they're productive, There'll be jobs, there'll be wages, there's income, and what? Consumption will go up. And where does somebody that works at Taco Bell for $14 an hour? Okay, you have Taco Bell. Okay? And you have a shift manager that makes $17.50 an hour. Okay? Where do they shop? If they earn this, yeah, they pay some rent. I gotcha. Yeah, they buy some food. I gotcha. But where do they spend their disposable income? And you're like, well, he doesn't have much. Well, think of it over, how about 100 million people? They go to Walmart. Great. So this dude goes to Walmart to what? Buy American? Yeah, or Dollar General, right, Johnny? Where does this stuff come from? Exports minus imports, net X. So, imports go up when things are good, and when things are good, dollar is bad. Oh my God. So now you have to think in September, if the government allows the emergency extension of unemployment benefits, if they get rid of that and it forces the 7 million people that used to work that don't work now, if it forces them to get a job, and I can tell you, from the southern United States to the northern United States, there are jobs. Oh, but they're not good jobs. Well, you didn't go to Harvard, son. So stop living off the government and be productive. It's not the government's fault. Do your best. Stand up. Work at Applebee's during the day. Take night classes right? From your apartment on a laptop. And then run Applebee's. Be the assistant manager. I mean, I don't know, step up. Okay? But anyways, if 7 million people go to actually being productive, GDP will go up. All of it. Consumption will go up. Investment will go up. Government spending should be stable. We don't need another $1 trillion, Biden. Okay? And then exports will probably be about the same. Okay? And imports are likely to go up. All of that is good. I want people to be productive. You have to understand. I want people to be productive. Dougie's my Ethereum Classic. No! Yeah. Wrong one. Yeah, there you go, Jimbo. I'm trying. Yeah, I know what you're saying, but Jimbo, my son is most likely. He's not 19. He's younger than 19, but we're in the process of starting his first company, and he wants to make $2,000 a week part time, and I'm like, Papa is going to help you. Okay. Then he's like, Dad, I need a golf cart to go to school. I live in a community that has 100 miles of golf carts. So everybody here has a golf cart. I said, hey, I'll do anything to help you start your business. I'll help you buy equipment. I'll pay for you buy the website, I'll host it. Need flyers? Don't worry. We can get some flyers made. I mean, you need graphic work? We'll get that made. We need some programmers? Hey, we'll work on it. Don't worry. I'll do anything to help you. Then he's like, Dad, will you buy me a golf cart? And I'm like, hell no. So can I take your golf cart? I'm like, no, it's my golf cart. You can't take my golf cart to school. Why not? Everyone else does. Well, I don't care about anybody else. Well, why can't I take yours? Well, it's got a custom paint job. It's lifted. It's got fancy wheels. It's got speakers. No, get your own golf cart. You want a golf cart? Start your company. Go out, work your ass off, earn the money, and buy your own golf cart. It'll probably be a cheaper one. But then what? Over time, pimp it up. Right? Get better seats. Put in awesome speakers. Right? Oh, man, you should save your money and get a bazooka tube. You know? But I ain't buying you a golf cart. Get out of here. Okay? But you want to start your own business? I'll do whatever it takes. I'll loan you the money for that. But I ain't buying you something. The difference now is productivity. So I raise my children like I would be president of the United States. Jimbo's like he's in college as well. Yeah, that's a tough one too. Gee whiz, that's a tough one. Cool. Hey, by the way, I'm going to be in New York City 1 week from now. People are going to gather. We're going to meet at the Harvard Club of New York City. We're going to go up onto the roof and have some cocktails and some snacks. And then we're going to Uber over to a cigar club and be ballers for a day. Paint the town red. Okay? Anyone going to be in New York City? We're just going to gather. That's it. No lecture, no nothing. Just we're going to gather and be traders, man. Talk to other traders face to face with a drink. Oh, I used to trade options. Forex is so much better. Oh, I love those pips. I love pips. Okay. Yeah. So if you're going to be in town, let me know. Wayne at FXBootcamp.com. Yeah. All right. So let's take a look at the indices, see what's going on. Dollar's got some strength. Yen coming down. Lovely tulium. See, the United States doing well. Sell the yen. Swissie's weak. The United States is doing well. Great. United States doing well. Canada going up. Dollar strong. So euro comes down. Why? Nobody actually cares about euro. Sorry. Okay. Sorry. Nobody cares about euro. So if dollar's up, euro's down. If dollar's down, euro's up. No one's actually trading euro. They're just trading dollar, and euro's in the way. It's a consequence of the dollar. Okay? If the United States is doing well, maybe China will do well. Maybe if China does well, Asia Pacific in the form of Aussie and Kiwi will do well. Oops. Okay? Yeah, I'd like to do another trip to Brazil. I haven't been there in many years now. Yeah, we'll have to do something like a February meeting in Brazil or something. Okay. Hey, by the way, Jimbo, McDonald's pays $50 for a kid to show up and do a job interview. And if they're hired, and you know they're going to be, they'll hire them, right? If you work at McDonald's for 90 days, they give you an iPhone. Wowzery, wowzer. Okay. Oh, is that right, Diego? I don't know about carts. A friend of mine has like I think it's a $2 million electric race car. It's like Formula One or something. And that's pretty cool. Oh, Peter says he does care about Euro. Sorry, Peter. Man, I always step on Peter's toes. Okay, this is that peso trade. Okay, the psych level is up here, obviously. Okay, so as long as we're below that, we should be fine. Okay. So you can see, even though the dollar is currently strong, I believe between now and the next 8 to 9 weeks, it will not be strong. So I have to plan accordingly. It'd be great if this held, but it may not. Okay. So I sold it sort of in here somewhere, and you can see I'm not making hardly any pips. I'm basically break even, but I've probably earned 5% interest already. My IRR, not my ROI, but my IRR is probably 5%, which is a freaking good year if you're in the bond market. You're like, wow, what are you doing? Buying junk bonds? Okay. Malik, what time frame? Oh, and by the way, you're asking a question, and I just spent 45 minutes to an hour answering that question. So apparently you logged in late. Hey, no problem. But I'm not going to tackle that all over again. I explained it in great detail using real yields. Okay? So if you know anything about yield curve analysis, then that's what I covered. And you'll say, oh, okay, well, that makes sense. Okay, so you'll see here on peso, okay, this is my sell zone. Wait, oh, Eurozar. Ooh, sorry. On Eurozar, this is my sell zone for August. And what this is suggesting is this. Cool. Cool. Kill. Cool. Good. Good. Fine. Fine. Great. Good. Let me update this. And I'm going to add a conservative target, not just an aggressive target. And this suggests 16.65 to 16.41. So why don't we just say, I don't know, how about 16 and a half? How does that smell? You're selling it at 17 and a third, going for 16 and a half. Cool. What, 600-700 pips? Sweet. Tiago says, hey, Wayne, you spoke to last week's swing group to mentally prepare yourself for a euro dollar double bottom. And it happened right on Friday. Yeah. Cool, right? Cool. Cool. All I can do is sort of like set the stage, right, Tiago? I just have to set the stage and keep reminding you guys what's most important at that moment for you to make decisions and to be ready. But ultimately, you still have to make those decisions. And ultimately, it never is easy. So even if I'm doing my own analysis, I still have to, it's still difficult, right? I mean, but if you don't have the analysis, oh my gosh, it must seem like magic, sometimes black magic, right? All right, so Hacks is kind of interesting. Hacks, right, Jagdev, says, hey, because the candle, will this do something? Well, first of all, that doesn't make sense. Nothing does anything because of the candle. Okay, but let's go look at gold, oil, and Bitcoin, huh? People want to buy gold because of dollar or yields. And the dollar is directly impacted by foreigners' participation in the yield market, as I've already shown you. Okay? So gold is gold. Okay? So now, what are you asking? Is gold going to go up because of this 4-hour candle? Here's a 4-hour candle. I would never even attempt to think that way. All right, so that's just dangerous in my opinion. If you are a bull on gold, it's more like, would you buy a bottom here? Or even lower. So if you talk to me, I don't know, last week, 1 week ago on Friday, I'd say you'd have in fact, I've actually drawn this. So let me explain this chart. As soon as I said it, I'm like, oh, that's what this chart says. So imagine we were here on Friday and you told me, Wayne, I'd like to buy gold. Okay, let's talk about it. Okay, Jagdev? All right, there are 2 trade plans I would recommend for a bull. This one, okay, because it's obviously support, role reversal, support, multiple reasons why, and an M2. Okay, a weekly M2. So, when you're in this period here, I guess that's a monthly. That's monthly, sorry. Monthly M2. Okay? So if you were a bull in this area and then you saw a reversal, not on a 4-hour, but maybe on a 15-minute, okay? Then you would have permission to buy it and go long. Wait, that is weekly. This is monthly. Anyways, I have to probably redo this chart. Anyway, so, no, that's right. So let me redraw this. Okay, I'm mixing this up because this to me looks like weekly, but that's the monthly. So your target would be here. So if that were true, for example, if the opposite happened with non-farm payrolls, if it was bad, maybe gold would go this way. Why? Because real yields may have gotten more negative or something. Okay. But anyways, you would have this and you would be buying it around 18 and your target would be approximately 1858. Maybe 1872. So let's just say you're buying it at 18, going for 1850. Cool. Okay. Now, that's plan A. Plan B, on a week ago, I would have said, if you were a bull, we're going to look at this territory here as a potential for buying. And I've already got it all marked out. Okay. So I literally did this a week ago. And you could say, well, if it occurs early in the month and you got down near 1750, you want to look for, on a smaller time frame, a reversal pattern. And if so, the first target of the first leg of this move would be back to 18. So you're either buying it at 18 going for 1850, or you're buying it 1750 going to 18. And then, of course, more likely back down to 1790, and then through here to 1837, down to probably 1810-ish, and then up to 1850. So really, I'd think a little farther out and say, well, the fundamentals and seasonality would lend this to, well, probably $100 move. And then based on that, I would probably start planning out even further. I might buy it at 17 going for 2K. And so for that, I'd need to really back out. Okay. And you'll see I've already done this work too. So here's what I planned out even way back in here. So you could be buying it at 1750 or 18, going for 19 to 1927. But you're not going to do it in August, not even September, but probably by, let's say by Thanksgiving. By the third week of November, you'll probably start scaling out of this trade. And if you're a real baller, you're going for the third week of December and the 2K number. Does that make sense? But to the other person that said, do I buy this because of the 4-hour candle, blah, 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 blah? That it's weird logic to me. Huh? Weird logic. Yeah. Cool. Plan B sounds good. Good. That's how I think. By the way, when I teach you guys how to trade, so you can go to FXBootcamp.com. FXBootcamp.com. Okay? When I teach you how to trade, especially in our live groups, we do this a lot where I say, I'll ask you a couple of things. Are you a bull or are you a bear? I don't know what you are. And one of the discussions we had yesterday in the live group was that it doesn't really matter. I just want you to be one or the other. And there'll be part of the year you'll do really well, and part of the year you'll have a lot less to do, but your volatility in your performance will actually improve. Okay? But what we'll do is if you're a bull, then I'll say, well, this is a plan A and this is a plan B down here. You're like, well, which one do I have to do, Wayne? Well, you need to be here in the moment, set it up. You're watching plan A in a 15-minute chart. Non-farm payrolls comes out and it drops like 100 pips in 10 minutes. Probably not a good idea to buy. Okay? What do winners do? Okay? What do winners do? And this includes professionals, because you can be a professional and lose money. What do winners do? Winners buy dips in an uptrend. Okay? Winners do not buy dips in a downtrend. So if it just made a lower low, well, that's not an uptrend. So back the heck off. Okay? Yeah, Jimbo wants to talk about the reverse repo market hitting $1 trillion a day and stuff like that. No, I don't want to talk about that. It's just that I don't. That's not something I track. I follow. I've correlated that kind of stuff. So I don't know. Cool. Okay. Cool. Mary John says, hey, I found big resistance monthly. Well, you still have to carry it out on a small time frame. So when you enter a trade, you should be on like a 15-minute chart or a 5-minute chart, likely at a market open, and you're at support and you think you're a bull because of monthly support. That's fine. You still got to be on a small time frame, and then confirm it with price action that it's gone from bearish to bullish, and then you engage. Cool. Arfa's like, simple golden rule, back the heck off. Yeah. Well, it wouldn't be euro, it would be weak dollar, Arfa. There's a difference. So, as I've already explained, you should track the bond market to see, right, if that flow of money is toward the United States or away from the United States. So you would want to look for something like this, y'all, on a 15-minute chart, let's say, somewhere around 1750. See, I know the price in which I want to engage. I just don't know the time. Like, when do I pull the trigger? I don't know that yet, but I do know the price. Around 1750, if I see a reversal pattern on a 15-minute chart, not a day chart, okay? If I see something like this, then I do want to engage. Okay? If I'm a bull. That didn't happen here, but it might happen here. If it doesn't happen here, I still don't engage. Now, the probabilities of it bouncing are actually pretty good. It's why it bounced over here. So it may bounce over here again. Okay? Just like this held, this might hold. Okay? So you sit and you wait. And when you get near 1750, we're at 1770, so I guess you can play around with it and say, well, it'll fall a little further, but you should start looking for reversal patterns. On a 15-minute chart, what kind of reversal pattern? How about hit this, rally up, drop down, rally up, drop down, buy. Which means you might buy it later this afternoon before the New York close, or you might buy it on the Sunday/Monday open. But you cannot buy this until you have a reversal pattern at support. Okay? If you're a bull. You cannot. You do not have the authority to engage until you have a reversal pattern at support if you happen to be bullish. And even then, the market's not bullish yet. You're just buying a double bottom. A double bottom is not a reversal pattern per se. Okay? Because it could just become range. So the next part of this is if this goes up here, okay, then maybe we start getting a move like this over time. Okay? More likely what you'll see is down, up, some down, some up, and then sideways, and then up, and then sideways, and then up. And then you'll say, oh, look, he was right. Okay? Mike says, isn't it better? Well, it's just a different level of risk. Is it better? Not necessarily. Because in that case, it is more conservative, but your stop has to be farther away. The other one is more aggressive on the entry because you're closer to support, but therefore, because you're so close, you don't need as big of a stop. Okay. Can I do USD Swiss franc? Let's, oops, you know what? I want to do oil next. Stock market's open, by the way. I want to do oil next. Did gold. Then we should do some Bitcoin. We'll get to USD Swiss franc. The problem with it is that both of those are funding currencies. So I generally never, I like that, general and then certain, right? I generally never trade USD Swiss franc. It doesn't really make any sense. Okay? So if you know me, I'm a macroeconomic trader. I'm a trend trader based on macroeconomics and money flow. So for example, when things are bad, money flows to the United States and to Switzerland as a safe haven. So asking me to trade something that on the long run, when impacted by macroeconomics, they individually both likely get strong or both likely get weak. So even though one might be strong today and the other one's weak, or maybe they're or somewhere in between, like, it just doesn't make any sense. I would never trade it. Just, okay, that's a relative strength trade. And that's too backward looking for my style of trading. Can you do it? Yeah, but I find that it works well when it's working and then it stops working, and it's hard to figure out when it'll stop working. So anyways, yeah. And same thing, like if you said, well, what about USD yen? Dude, same thing. Those are two funding currencies. That's denominator versus denominator. And it really doesn't make any sense. So, no, I probably won't cover it. All right, cool. All right, do you think oil's going to go up or oil's going to go down? Well, the analysis I have now is that the market is generally neutral, but if you're a bear, we're looking for $64 a barrel. Okay? It might end up being 65. That's why I have this here. Okay? So, to trade that now, between now and Monday, you would sell approximately $70 a barrel and target somewhere between $65 and $60 a barrel. This is 65. and this is 60. Oh my God, I already have that written down. I know, right? Because we had this plan on Monday. Huh? Think of it. You're asking me on Friday about oil. Where I already have this plan on Monday done. We already are looking for price action. So let me zoom in on the price action. Okay, you ready? Wait for it. Down, 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 up, up, sell. 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 So we're already in this process. And you'll see, even though I'm talking about somewhere around 70, right? I said between now and next week. But you'll see we already have that all set up. So you could say, well, Wayne, you would sell around this price because it's a roll reversal and we call that price action. Okay, good. That's price action for a bear. A bear would do that all day long. The next thing you might say is, Wayne, you would sell it off of the 4-hour 21. Okay, that's good. Okay, 4-hour 21, EMA, which by definition is bearish and aggressively bearish. Then someone else comes along and says, well, Wayne, you want to sell it off of this zone here, which is dynamic. So we know we have the assumption of down, which then, because it's dynamic and we're assuming down, by the end of the day, if it closes low today, this will probably drop down. We can guess around 70. So this area here, okay, which we knew up here, okay, is probably the sell zone. Okay, so weekly front run. So someone might sell it because they're a bear and they're doing a weekly front run. Someone might sell it because they're a bear and they're kicking it off the 4-hour 21. Someone might sell it because they're a bear and they're trading price action. Okay? But the issue is a lot of people don't decide whether they should be a bull or a bear, so they're waiting for this to happen to be a bull. Right? Have you guys tried this? You say, aha, look at that. So I'm going to buy it here. Oh, shit. And then you lose money. So then you're like, well, it's down, so I'm going to be a bear. But then, what if it turns bullish? Oh, you're always late because you're trading the past. I'd rather you say you're a bear. And this, by the way, if you join FX Bootcamp, and go through all the training courses, and there's dozens and dozens and dozens of hours of it. But you'll know, and you look at that and you're like, yeah, that's my number. You have your doubts though. That doesn't mean sell, but you have, that's your number. You're like, oh yeah, somewhere around 74.5, man, that's my number. And then you see it on the Sunday, Monday open, and you're like, holy schnicker schnacker. That might be my number. That might be it. That could be it. That's cool. Bearish engulfing candle. How do you trade a bearish engulfing candle? Well, you're like, well, Wayne, there's tons of bearish engulfing candles. Well, how about the bearish engulfing candle off the exact price that you were looking for? Oh, you sell the lower high on the right? Nice. Here, and then here, and then here, and you're going to do it here. Now, if you're a bull, you're saying, well, you know what? This 68's probably enough. Okay, you watching this? 68 might be enough for you if you're a bull. You want oil prices to go up. Cool. So wouldn't you like to see a double bottom? The very least. So why don't you look for a double bottom on Monday? Get the hell out of the way today. Check it out on Monday. You're like, well, what about 68? Can I get a bounce at 68? Can I get a bounce? Huh? Bounce with me. Bounce with me. And all of a sudden you get a little bounce. Take a shot, bro. Take a shot. Or you wait for this to breach. Ha 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 ha. Okay? Now, where are your major threats as a bull? Well, you already know. Someone's going to sell this between 70 and 71. You already know that. That's what the chart says. Okay? If you don't know the technical analysis, you're really in trouble, man. I get it. You're like, man, I don't understand fundamentals. I don't have a background in economics. I don't really get these things. Central banks seem magic to me. I don't know all these things. Well, then you better learn technical analysis. And if you don't see like that there are sellers here, then you're really going to get crushed. Doesn't mean it can't go up. But here's what a lot of people do. They're like, well, I'm going to wait for it to double bottom. Okay, now it's double bottomed. It's up here at 70. Now I'll buy. Dude, seriously? Slow as molasses on a cold Georgia morning. Like, you can't buy it way up there, for crying out loud. What the heck? Bulls buy low. They don't buy high at resistance. They buy low at support. Okay? So we know the bears are going to sell where? At resistance. Why? That's what bears do. Okay? That's what the bears do. The bulls, the bears. Okay? That's what they do. That's what you're supposed to do if you're a bear. Okay? Now, I would argue if it goes from 68 back to 70, the best a bear could hope for is a range. Okay? The best a bull could hope for is breakout, pullback, and then go. And even then, you're vulnerable because you're still in the sell zone. And you're basically trying to reverse the entire market. Well, you better be careful. You might be trying to be too clever. Okay. In this moment, it's showing bearish. Yeah, but look at this chart. Look at this. Okay. You have to understand there's nothing bullish on this chart. Nothing. For the whole entire week, it's only been bearish. So you're like, well, it's showing bearishness now in a 15-minute chart. Yeah. Yeah. Right? Like, yeah, there's nothing bullish at all. So, yeah, you're right. Okay. A bull would have to wait. And like I said, maybe Monday. Take a look at Bitcoin. Okay. Worked out really nice. I made some money on Bitcoin this week. Paid for my trip to New York City. I was long here and exited that candle. Right at the top. Nice. Now what's happened? Well, statistically, not a lot. Okay. Now emotionally, is this a breach over 40? Could be interesting, huh? Could be interesting if that's a breach over 40. Inconclusive in the moment. But for Bitcoin to really break, you need A, people to buy Bitcoin, and B, the dollar to weaken. Okay. It was a business deal. It was cash. It wasn't a trade. But I held on to it for the weekend and made $3,000. You know, I don't follow the Nifty 50 index, right? It's interesting, though. That is an old index from, it's the 1950s, but that's not why they call it the Nifty 50. But even the Dow, you know, what is that? That's basically international, right? It's basically, I'd call it just some sort of international index. Anyways, how do you trade Ethereum? Buy in the green, buy in the green, buy in the green, and if it rallies up next week, you might want to buy in the green. Cool. Very, very difficult stuff. Very, very complicated. All right. Yeah, well, there's stuff going on there, right? Yeah, there's stuff going on with Ethereum, sure. Very interesting. Let's go back to the indices. Okay. So right now, Swiss franc versus US dollar, right? USD Swiss franc should be going up. Cool. Gotcha. Still don't want to trade it. Okay. What does it mean to macroeconomics? Okay. Macro now, the whole world. What does it mean to global money flow if the United States is doing well enough that it does not need emergency stimulus? Global money will flow. The interesting thing is, yen is typically strong this time of year. You should know that, by the way. And I think we're going to do this. Okay? You're welcome. Please buy me a cigar or a classy bottle of wine. There you go. I just predicted the future. Okay, that's a freebie. First one's free, baby. Ooh, should I respond? Hello, my name is Joanne. Nice to meet you. Your number appears in my address book. What's your name? We know each other? WhatsApp, huh? That's interesting. Foreign, I think a Chinese phone number. How interesting. Daniel, nothing healthy. Well, you know, Daniel, I care about health. That's important. I'd like to announce that I have lost 5 pounds in the last month. Do you think that the Olympics has had an impact on the yen? No. Nikkei? I don't care about Nikkei. It's fake. Nikkei is fake. The Bank of Japan owns something like 70% of the Nikkei. I don't care. It's fake. It's like some of their zombie companies. It's a zombie index. Not interested. But I love the Japanese yen. Love it. I love to hate it. Okay. Cool. Cool. So, a continuation of this. Okay, and I believe it was here where I said this is likely to go up for 5 years. How many people here understood this? when I said it here. April 2020. How many people were there for this? And I believe I said it here at FX Street. I believe I said it at my daily webinar for Traders Way clients. By the way, if you visit tradersway.com, open up a demo account in your back office, there's a button to join my daily hour-and-a-half webinar where I teach you how to plan trades technically and fundamentally. Okay? How many people understood this way back in April 2020? For 5 years, not 5 hours. Coco bought it. Right on, Coco. Tiago says, what am I doing? I'm drinking less alcohol and eating less fast food. Cool. Nobody else, really? I might have said it Aussie versus USD, but it's the same thing. See, remember, I was talking about denominators. To me, it's the same thing. This would be your, I believe the way I explained it is this is your China play. If the United States is doing well, they're going to buy more stuff from China. If China is doing well, they're going to buy more stuff from Australia. Australia's top 2 exports are iron ore and coal. Coal, the clean coal from Australia, is used to power electrical power plants. So if the Chinese economy is expanding, they're going to need more power. So they may buy clean coal from Australia. Also, if you take iron ore and you melt it, and then you sprinkle some carbon coal, okay, you get steel. Anyone that's played Minecraft knows this. Okay, so if the United States is doing well, China will likely improve. If China is doing well, they're going to buy more stuff from Australia. If they're buying iron ore and coal from Australia, then they're going to need Aussie dollar to do it. And Aussie dollar goes up. Cool. What do you think of that? So let's look at Piggy. Still caught up. Still caught up, which is great. It's fine. Okay, let it do what it needs to do. Euro. Let it do what it needs to do. We're at monthly support, by the way. Could get interesting here. The monthly projected bottom, okay? So again, let's go back to August 1st. We were here, okay? I'm not expecting euro dollar to go up in August, okay? Not in the beginning of August. I don't think I've ever, in 20 years of doing live webinars, ever suggested euro dollar would go up the first week of August. Maybe the third week of August, maybe the fourth, but not the first. So anyways, we'll see what happens. This could be statistically relevant to us because it's one standard deviation from the mean. This is one standard deviation above the mean. Okay? And so maybe down here, closer to 2 standard deviations from the mean, which is 95% of the projected price action over that previous period. Okay. Here we go. So I have to zoom in now. What did I just do? You see this? I plotted July. Okay. Isn't that interesting? Cool, right? You got to understand what your technical indicators are doing, yo. Okay? If it was going to be a bullish breakout trade, it would have kicked off the top here and gone up. The average, the mean actually, not the average, based on the slope of the mean, is this. A deviation below the mean is here. Okay. I don't really think it's going to happen, but this is what the calculations are calculating. You got to understand your algo. You got to know the math. It's cool, right? Here's what I would like. That would be cool. Okay, that would be cool. Nice. And I'll leave it at that. It's 10:00 and I'm spent. I'm going to have myself a cohiba. Sit in my backyard and stare at the lake, listen to the geese and the landscapers blowing leaves for a neighbor's yard. And I'm going to sit in my sandbox like I'm a 5-year-old kid. And I think, I love being a currency trader. This is the best ever. If I want to work at 3 in the morning, I work at 3 in the morning. If I want to work 12 hours a day, 18 hours a day, I have the freedom. If I want to work 18 minutes today, I'll work 18 minutes. Love it. But the thing is, you should never stop. So I take you guys with me everywhere. If I'm sick, I trade. If I travel, I trade. If there's a hurricane, an earthquake, a tornado, a thunderstorm, a hailstorm, floods, I trade. But what's the big deal? Running a restaurant is very difficult. And you never get time off. Okay? You could be a police officer. People spit at you. Call you names. And you're like, dude, but I'm a police officer. People shoot at you. What the hell? That's tough. Forex is a lot easier than that. You want to be a farmer? Sounds like fun, right? You want to get rich quick? Yeah, you should become a farmer. It's easy. Just borrow millions of dollars, throw some seeds on the ground, boom, nature does the rest. And you just harvest the cash. This is the kind of message you hear about Forex from idiots trying to pitch you a dream. You want to be rich? Be a farmer. It's easy. Just go to the bank, borrow a whole bunch of money, boom, throw some seeds, man. It just grows itself. And at the end, you harvest the cash. Models and bottles. That's what farming's like. No, it's not. But it is a lot of hard work. And it's never ending. And it's very risky. And you have to be very smart. Okay? Razi already did it. I spent a lot of time on it, actually. Yeah, be a doctor. Hey, you want to get rich? Boom, just be a doctor. Oh, that's right. You're going to need like 15 years of experience and then work like a dirty dog interning. And then what? You become a real doctor. Yeah. You know, I was at a doctor's office recently, and the nurses are awesome, right? Nurses come in and they do everything great, and then they leave. And then someone came in and like, hi, I'm Cindy. Are you having a good day today? I'm like, Cindy, who are you and why are you in this room? Oh, well, you can consider me like, customer service. I want to ensure that you're having a great experience here. Well, despite you feeling so bad. I'm like, dude, you don't even know me and I don't feel bad. That's not why I'm here, right? And she's like, well, look, so have the nurses communicated with you very well? Have you found the room to be clean? And I'm like, whoa, dude, are you narking on my wonderful nurse? Are you fishing for complaints? I'm like, oh my God. And so she leaves. I'm like, just get out of here, Cindy. And then the nurse comes back and I'm like, dude, is this Cindy chick? Like going from patient to patient, basically doing live surveys to find out if you made a mistake in the last 10 minutes? I'm like, I would hate that. I would hate that is what I told her. Sick, right? Well, you know what? All we do is buy, sell, or do nothing. So you can't complain. What we do is awesome. Yeah, you have to do it all the time. So you better fall in love. Let me tell you something. If you're looking to cut corners, you're trying to find a magic indicator, an EA or an algo that does everything for you, something that makes decisions. Maybe you can get something and it'll say red candle, green candles here, red candles there, buy and sell, and it'll just do that for you. And then you can put some dude, if you are trying to cut corners, you will never make it. You will never make it. You should love the job. You should love doing the analysis. You should be able to bust out the research tools of the Fed, for example, and just like, hey, let's look at yields and real yields, and let's look at the, what happens during a recession, and then correlate that out to the dollar. Like, you should love it. You should get excited about it. You want to do the work. You want to read the papers. You want to read the reports. You want to watch the speeches. You want to make the big decision because you're the boss. You create value. People will come to you and say, Wayne, I'm very uncertain about the future and I have all these assets at risk. Help me, Wayne, help me. And you say, well, you know what? I've done all the dirty work. I've gone through the weeds and analyzed and thought and agonized on all the data and what it'll mean in the near future and the little bit more distant future. and I can help us make good decisions with your assets. And they're like, oh, thank you, Wayne. Thank you. By the way, I'm going to need some money. But the thing is, you are providing somebody with value. So once again, if you love being a currency trader and you are passionate about doing the research, then you will be able to make wise decisions. And people will turn to you and find your decision-making process, your research, and the ability to trade what you've researched, things like patience and discipline. They will see that as value. Wayne, can you do this for me? I need your help. I like what you do. I like who you are. But I'm incapable or unwilling to do this work. I got other things going on, but I have assets and they're at risk. Will you provide value? Will you help me make the right decisions? And I'll say, yeah, for money. You got money? I like to go to Walmart and I need the money. Okay? And so you provide them value and they give you money so you can go to Walmart and drive up consumption. Or you buy the stock market, drive up investment. Or you buy real estate, drive up investment. If you go to Walmart, you're driving up domestic consumption, but also international imports. And now the dollar weakens and you're making money doing it. So I don't mind going to Walmart and they're like, look at this, a 4K TV, 65 inches and it's $400. You're like, well, I don't really need a TV, but I'm short the dollar, so I'm going to buy it. Because I'm going to drive up consumption, but also drive up imports, and that will lower the value of the dollar, and I get the TV for free. Nah, I just buy the stock market. By the way, I bought retirement communities. I bought dollar stores, not the dollar store, but a basket of convenience stores, right? Right? So old folks' homes, dollar stores. You know what I just bought? Prisons. I bought prisons and the stock went up like 10% in a week. I love it. Assets, baby. Assets. So we're very lucky. We're very blessed, and I thank you for all your good karma that you share with me every day. I'd like to thank FXstreet for hosting this webinar for well over 15 years. It's more than that, right? 184 months? I don't know how much that is. But anyways, I've had a relationship with them for pretty close to 20 years, so I appreciate FXstreet. Thank you to Traders Way for being trustworthy and reliable, and I don't know, give them a shot. Visit Traders Way, let them earn your loyalty and respect. Like I said, if you open up a demo account in your back office, there's a button that will take you to my live streams I do every day for clients for free. Something like this every day. Just open a demo account, tradersway.com. And if you want to learn how to trade like the Wayne do, well, over the years, people have asked me to teach them. So I built a bunch of training courses. You can take them whenever you want. Simple enough. FXBootcamp.com. Technical analysis, fundamental analysis, trader psychology, monetary policy, macroeconomics, how to use MT4. It's all there. So, without further ado, again, thank you for your positive contribution to this awesome webinar today. Peace on earth. May the pips be with you. May your profits be above average. I'll either see you on Monday at tradersway.com or I'll see you at FXstreet for Trade Non-Farm Payrolls live month number 185, the first week of September. Have a great weekend, everybody, and thank you to the moderator. World's greatest moderator. Nobody moderates like our moderator. Thanks, Mod.